Welcome back to the podcast. I'm joined as always by Ernest Wong, Head of Research at Baskin Wealth, and I'm Barry Schwartz. What's going on with you today, Ernest?
Finally starting to snow.
It's good. It's good. That winter is, winter's finally starting for those that like to ski and snowboard and shovel snow, although kind of late this year. Do you think climate change has anything to do with it or just wacky weather?
It's also El Nino.
Yeah.
Right?
Okay. What does El Nino mean?
It's a weather phenomenon
that
happens every 4 years that has some impact to the weather.
So I have a very hard driveway to shovel, a very long driveway, very skinny driveway. And we hired every year we try and hire a new guy because they fire us because our driveway is so hard to shovel. This year, I think the guy has so far shoveled once. So it's been a good year to be in the snow removal business.
Tell your son to do it.
Yeah, tell my son. Yeah, exactly. Ernest, we're in a bull market. And for the S&P 500, it hit all-time high the other day. TSX, not so much. It's been 2 years, of course, in a bull market where we haven't had a bull market. It's been a tough couple of years, but a quick recovery in the S&P, quick recovery in the NASDAQ, of course. How should one behave in a bull market? What do you think?
I think it's very tempting to try and time the market. Mm-hmm. I think everybody wishes that they could have sold at the top in 2021 and bought at the bottom in 2022. But history has proven that that's a fool's game. You're not going to time it properly.
Yeah.
Doing so is generally costly because you have to pay taxes and you have to pay transaction fees and you have to, and you might miss out on further gains.
Yeah, you have to be right on the sale, right on the buy. You have to also be right on which stocks to repurchase or which index to repurchase. It starts getting pretty hard to get all of those variables right.
I think it is prudent, of course, for an investor to watch for the valuations of the names that they own. But beyond that, I think the best thing to do is nothing.
So 2024 started off pretty hot as well. Of course, we're in a bull market for U.S. stocks. Valuations have picked up, but we're not in any way silly as they were in 2021 yet.
No, I think we're quite far away from that point because 2021 was certainly not going to forget that anytime soon.
Yeah,
there were people with like laser eyes on their Twitter photos.
Explain what the laser eyes mean for those that aren't on Twitter.
So basically, in 2021, cryptocurrencies were all the hype.
Yeah.
And you can signal to other people that you were part of the party if you had laser eyes. You put like two lasers in your eyes.
All right.
And
so you change your profile picture to add laser eyes, and that tells everybody that you love crypto. Of course, I think probably people remove that quite quickly in 2022 from their profile pics.
Yeah, I don't see many of those today.
Yeah. So FOMO is hard, and the fear of missing out. It's, as it turned out, a lot of people wanted to buy GICs or treasuries or put their money in cash at exactly the wrong time, even though they were attracted to the higher yields that those products have. It's counterintuitive, but it seems that the best time to sit on cash or hold those type of safe investments is when the markets, when the yields of those things are very low and the markets are very high, not when the markets are low and the yields are high. But anyways, that's how it goes.
I think that's well said.
Yeah. So our feature conversation today is going to be about two companies that just reported earnings, Netflix and CN Rail. We've talked about them before on the podcast, and Ernest did an excellent job explaining the railroad in Canada on a previous podcast. We'll share on the show notes. If you want to learn why those companies, CN and CP, have been such dominant performers over the last 10, 15, 20, 30 years, and why Canada is such a good place for the railroads. I highly recommend you listen to that podcast. But Ernest, Netflix, holy smokes, the recovery, the crazy moves since COVID, the stock pre-COVID was about $200-300 a share. One of the best performing stocks on the U.S. markets for a long period of time. With COVID, everybody stuck at home. The Netflix added, I think, 100 million subscribers in a very short period of time. Just insane. The stock went parabolic, peaked at $700 in 2022. After the invasion of Ukraine by Russia, there were issues with subscriber growth. People were starting to leave the house. Netflix prices went up. They were starting to crack down on the profit sharing. All of a sudden, the stock cratered to $160. Now back up today in the mid 500 range. So Netflix, we want to explain, what's going on with Netflix and why we're still positive on its outlook. So Ernest, go ahead.
Yeah, I think it certainly gives much more meaning to buy and hold investing, right? Like it's really easy when you have something like Berkshire Hathaway that doesn't really go down and just pretty much goes up.
Drama free, pun intended, of course. Yeah.
It's easy to hold a company like Berkshire.
Yeah.
It's much harder for something like Netflix, even if you have a solid understanding of the financial statements and of the fundamentals of the business, to own something that can go up 100%, down 80%, and then up 200% again.
Yeah, no, and it's tough. And for those that watch their portfolios every minute, of course, it can drive you crazy. And yeah, price dictates a lot of our behaviors. Well, when something starts to crater, you're like, what am I missing? Am I an idiot? Let's get out. Let's get the tax loss. We can always buy back later. And of course, you'll buy back later at a much higher price because you're only going to buy back later after there's confirmation that the business is improved. And when the confirmation the business is improved, generally the stock price is a lot higher.
So what I would say for Netflix is that at the end of the day, the debate on Netflix's stock has always been about two things. Number one is, do people watch Netflix because there's a specific show that they want to watch on Netflix? Or do they watch a show on Netflix just simply by virtue of it being on Netflix?
So kind of like it's a channel, right? Netflix is a channel, Disney is a channel, and I don't know what I'm gonna watch. So I'm gonna turn on Netflix, see what they have. If it's no good, move on to the next. Yeah.
And the reason,
good thought process, yes.
And the reason that this matters is because if people are simply going on to Netflix because there's a show that they want to watch, let's say Stranger Things.
Okay.
Once the show is done, they'll cancel, right? And so if, like, under this scenario, there's no margin expansion opportunity for Netflix. They're not going to make money because they have to keep making shows for you to keep you as a subscriber. But under the second scenario, if Netflix can make a show and you'll watch it just because it's on Netflix, then it's a very scalable business.
Yeah.
They can, and that's what we're seeing with the stock today, or the financials of the company today.
Netflix has become, in and of itself, the brand. And because you trust the brand, the shows are going to be good or mostly good, and you're just going to keep coming back, and you're not going to want to cancel and repurchase and cancel and repurchase.
Right.
Yeah.
And so, and that's what the behavior of the Netflix subscribers are. They would sign on, see what's going on Netflix, and just pick something random to watch. And that's a really important thing to understand about Netflix because of this behavior, they don't have to spend money to keep you there.
Yeah.
It's a very scalable model, and you can see that with the profits that they're making today.
I mean, that said, I do get emails from Netflix probably daily saying, make sure to finish Seinfeld. I'm not watching Seinfeld. I've watched it a million times. My son is getting into it. Or it says, have you watched these shows? So they still are marketing to existing subscribers, I assume.
Yes, they are.
Yeah.
But you can actually see this debate play out in Netflix's stock price when it's at all-time highs, right? When it was $700. Netflix, there were articles that Netflix is an aggregator, right? It's the future of TV. When it was at the bottom, at 160,
Yeah.
the narrative is that Netflix is not going to be a profitable company. The competition is picking up. Like Disney and HBO are all making streaming services, and now I think it's pretty clear today that Netflix is
The clear winner.
Is the clear winner of this. It's a so-called streaming wars.
So before we talk about the results of 2024 or for the period ending 2023, let's dig in a little bit. Why did Netflix do so poorly in parts of 2022? Why did revenue growth fall to 6%? Explain the dynamics of what happened there. Was it just people over extrapolating such a good move prior in COVID, and as a result 2022 was just not as good because they had already gotten so many subscribers in a fast period of time?
It was mostly just because COVID was such a strange time for so many companies. Mm-hmm. I think you have to remember that everybody was stuck at home for about like a year or two.
Yeah, I don't want to remember that. Yes, but
and so anybody who would have signed up for Netflix would have already done so.
Yeah.
From March 2020 through 2021, right? And if you didn't sign up for Netflix during that period of time, there was probably some other reason other than their content not being good enough.
Okay.
Like maybe you couldn't afford it, right? Maybe your internet wasn't good enough. Maybe you were sharing your dad's password, so you didn't need to sign up.
Or you only like sports.
Exactly.
Yeah, and which Netflix didn't have until we'll talk about recently. Yeah.
And so subscriber growth slowed, maybe should have been predictably in 2022. And you add to the fact that interest rates started to go up, right? And the US dollar was really strong, so there were FX headwinds. And Netflix just had a really weak year.
So those that sold out in 2022, there was no thesis drift with Netflix. Not a lot has changed. It was maybe they saw a few tough quarters. They got whipsawed by price, and as a result, cashed out.
But I think, and here we have to give Netflix management a lot of credit, because they executed so quickly on their new initiatives.
Yeah.
They recognized what was going on, and they pivoted quickly, which is how any good businessman should do, or business person should do, is that when the situation changes, you have to react. Yeah. And Netflix reacted very quickly. They launched an ad-supported tier. So if you didn't want to pay $8 a month, you would pay for the ad. You can pay less and sign up for the ad-supported experience.
And that's apparently going quite well, right?
Yes.
Okay.
That's going very well. They cracked down on password sharing, right? So
don't I know it? So lots of people were complaining. It's not fair. I mean, it's not fair that you're not paying for your own Netflix subscription, whatever.
They cracked down. Yeah, they cracked down on password sharing, and that's been a big driver of subscribers in 2023 as well. And then now they are executing on sports, which they signed a deal with WWE to bring that to the service.
So let's talk about this WWE wrestling deal. It used to be called WWF for wrestling aficionados like myself. I was one of the biggest fans of wrestling growing up as a kid. You don't like wrestling?
No, I haven't watched it before.
So if we talk about Randy Macho Man Savage or Hulk Hogan,
no clue who that is.
No clue. I think around the office yesterday we saw The Rock, Dwayne Johnson on TV, and Ernest had no idea who that was.
No, so I know who The Rock is.
Yeah.
But I don't know why he's called The Rock.
Oh, you don't know? Okay, I think that was just his nickname, right? Anyway, so wrestling has ebbed and flowed, of course. It's but now it's mainstream. It's the WWE is a global, gigantic brand, reaching millions of viewers every week with a number of flagship programs and their pay-per-view wrestling. It's scripted, but it does look like they really try and kill each other. And people like the storylines. It's episodic, right? So if you miss 1 week, you're not going to know you're out of the loop, right? Because the storylines continue, and then they always lead up to a main pay-per-view or leading program like WrestleMania, and then that continues. I think WWE Raw has been on TV for like 30 plus years. That's their main program. And the bidding war, everybody expected eventually Netflix would get into live programming. So your take on Netflix and WWE?
Right. This is a big deal because it is Netflix's first major push.
Yeah.
They did this little golf thing before, but I don't know if that counts as sports.
And they had some live comedy programming. I think they had Chris Rock, and that was very successful. But, everything on Netflix is either put on once a week or dumped in one shot, right? So there's no appointment television.
Yes.
And this changes the game for Netflix. You got to be watching WWE Raw if you're a big fan every Monday night at 8 o'clock and you don't want to miss it. Maybe that you can watch it later on demand, but you're gonna, people will know the storylines and there'll be spoilers. So you really need to watch it every week.
Yes, and so this was Netflix's first big push into sports, and it's notable because Netflix has previously always said that they never saw a business case for sports. But as I think, as you pointed out, WWE is quite different from traditional sports like the NFL.
Yeah.
Right? It's scripted. You might want to return to it if you miss an episode, you can't watch the next one.
Yeah.
And the reason why Netflix, I think WWE makes sense for Netflix is there's two reasons. Number one is that WWE is a big brand globally.
Globally, yeah, right. Wrestling, people beating up each other, that translates across all countries and across all languages. It's that appeals to a lot of young people and maybe old people as well.
And Netflix has the largest international streaming base of any streaming company. So
what's the global reach of Netflix? There's 260 million subscribers, but I assume that over 1 billion could sign up today if they wanted to.
Well,
give or take.
Yeah.
You can watch it on your phone. You can watch it on your iPad.
Yes.
It's not just on your TV.
Netflix has always kind of put out a statistic of 500 million global pay TV subscribers.
Okay.
Relative to 260 million subscribers today. So still a long runway of opportunity just from people who historically have watched TV. And that's obviously not including the billions of people who don't have TVs and are maybe just signing up for the internet the first time.
Yeah. Or maybe they won't even bypass the TV and just watch it on their phone, or maybe one day on the Apple Vision Pro. Story for another day.
But Netflix will be, back to WWE, Netflix will be able to showcase and distribute WWE to its 260 million subscribers globally, which has not been done before, because WWE historically more distributed in North America than the rest of the world.
So they're paying over about $500 million a year.
Yes.
There's an option, but the last time WWE signed a contract for Raw, I think they got close to $300 million from Comcast. So this is a big step up for WWE. How will Netflix monetize and make money on this big contract?
And the timing of this is interesting as well, because Netflix has been working on ads and their ability to serve ads for a while. So I think prior to 2022, Netflix probably couldn't have bid on this contract, even if they wanted to, because they just didn't have the ability to serve ads in between the shows. But now they can, and I expect them to do more in this area.
I've read that full paying subscribers to Netflix, those that have the premium tier, won't see any ads on the wrestling, but those on the ad tier or the cheaper tiers will see ads during breaks and wrestling matches and what have you. So clearly they think they can recuperate some of the payment of the contract, as well as add additional shows and programming,
Yes.
sponsorship, and what have you. These are two very smart companies coming together, and hopefully it's going to be a win-win for Netflix. So we talked about the WWE. The results from Netflix speak for themselves. So why don't you get into that for a minute about Netflix's fourth quarter earnings?
Well, I think the other aspect that I think has been a little bit underappreciated or misunderstood about Netflix is that it is a very profitable company. I think for the longest time, I think a lot of the bears on the stock, they would say, oh, look at Netflix's cash flow. Like they're burning cash, they're not profitable. They're never going to be profitable because they're on the proverbial content treadmill.
Yep.
And I think that's just been proven to be wrong. In 2023, they earned $6.7 billion of free cash flow.
Wow.
Which is clearly not a trivial amount.
Yeah. And they used a lot of that cash flow to buy back stock as well.
Yes. And I think more importantly is that free cash flow today is pretty close to reported earnings. So that proves that their accounting is pretty accurate, contrary to what some people have suggested.
Sounds good. So, and Netflix spending comes at a time when maybe some of their competitors are pulling back. We have to assume that linear cable is now just 100% relying on sports.
And news.
And news. Could that change in the future with Netflix? Is this inevitable? Is Netflix just going to be the winner and we're all going to no longer pay for linear cable and Netflix will have the news and the sports eventually at some point in time?
Sports and news, I think, with regards to big four sports like the NBA or the NFL, probably not in the near future because it's hard for Netflix to be able to monetize these properly to the same degree that they historically have done in other types of content. But I think to the broader point about legacy media, I think there's no question today that Netflix is in a much stronger position relative to its competitors than it has been for quite a while and probably ever. You can see that with Disney and HBO. They have been pulling back on their streaming and have started licensing content back to Netflix again. And Netflix is the only company, again, that's profitable on streaming.
As a side note, Ernest, this is why you should own market leaders and why in a high rate environment, market leaders gain market share and trounce their competition. Yes, interest rates can hurt market valuations for stocks, but think about the fundamentals. Higher interest rates make it harder for companies to finance new projects, to launch new businesses off the ground, to cover their debts. Disney and Paramount and a lot of the NBC with Peacock, Comcast, a lot of debt. So whereas Netflix, as you said, they're gushing free cash flow. They're in a great position. So very interesting. So what do you do with the stock here, Ernest? It's up dramatically in 2023. A nice start to 2024. It's no longer, I don't know if stock was ever fundamentally cheap. Maybe it was at $160 at the bottom. It's never been a cheap stock, but the earnings are finally here. What do you do with the stock? Where do you see earnings over the next few years? If you can provide some color there.
I think the competitive positioning of Netflix is clear at this point. Right? There's no more debate about whether Disney's going to come in and disrupt Netflix.
Yeah.
Like, that's not happening.
No.
I think stock today trades at about 30 times consensus earnings.
For 2024, yeah.
2024.
Yeah.
I think it's still reasonable value. Stock might fluctuate here or there based on various quarters results and those kinds of things. But I think the important thing to think about Netflix is that it's a fixed cost business. Right. If they make a show and they add another subscriber, the flow through profit of that subscriber is very, very high.
Yeah.
Right. And that's why Netflix doesn't need to add too many subscribers for profits to really go up substantially. And I think that's one of the things that you saw in the 2023 results.
You start making a lot of money on the last few subscribers that you get.
Yes.
Kind of like the airlines. They only make money on the last few seats that they sell on the plane. Although We don't ever want to get back into the airline business. So,
and yeah, so globally, very long runway of opportunity to add subscribers. They're growing pretty rapidly in the ad-supported business. We'll see what happens with video games. They're also making a push into that.
we didn't even talk about pushing the video games. You always say one of the things about strong management is they can surprise you.
Yes.
And so the WWE deal, surprise. Going to gaming being a success, surprise. Launching the ad tier. There's more to come from Netflix. I also read, for people that don't know what's going on with Netflix, they're getting into the live theater business as well. They launched Stranger Things play in London. They're working on other, they're trying to build a brand. Who knows? Maybe they'll build a theme park at some point in time. God only knows.
Yeah. So bottom line, it's a very well-run business, very profitable, long runway of growth, and happy to continue owning it.
Sounds good. So Netflix, there is drama with the stock price. You could imagine that there could be a quarter in the upcoming where they miss subscriber growth. The stock plummets 10%. We love the runway of opportunity with Netflix, but once in a while, it's nice to own a company that has a little less drama. And one that we're going to talk about is CN Rail, the Canadian Railroad.
Right. So for CN Rail, Canadian National Railway, it's one of the two main rails in Canada, along with Canadian Pacific.
Is it larger than Canadian Pacific?
By freight and by revenues, yes.
Okay.
They are bigger, but I don't know if that's true after the Kansas City deal, but
Gotcha.
That's neither here nor there.
Mm-hmm.
Unlike Netflix, there's no battleground debates on the economics of Canadian National Railway.
Yeah.
It is what it is. It's a railway that moves stuff from one coast to the other of Canada.
Mm-hmm.
Canada's a big place. They spend a lot of money, but they make a lot of money too.
Yeah.
And the stock price is not nearly as volatile as Netflix.
That's right.
On the other hand, of course, there's no grand narrative about disrupting linear TV for CN Rail. It'll continue to do what it does.
It moves heavy stuff and lots of stuff that at the moment can't be disrupted by anything else. And especially the geographic issues with Canada. You need railroads. CN and CP both have made a lot of acquisitions over a few years. CP with a bigger splash, of course, acquiring Kansas City Southern. But CN has still been acquisitive, acquiring other smaller railroads and growing its track inside Canada as well, in North America and the United States. So its results, or the railroads had a tough year in 2023, right?
Yes, 2023 was a rough year for the Canadian rails.
Why is that?
First of all, 2022, if you remember, was a year when everybody was worried about shortages. There was just not enough freight.
That's right.
Right. And so what happened was that all the retailers, they ordered way too much stuff. And going into 2023, the retailers had too much inventory and they just didn't need to order as much stuff.
And is that their most profitable part of the business, the intermodal, where they're moving stuff, not the grains or the commodities, but actual heavy stuff from one coast to the other or to one terminal?
It's not their most profitable, but it's certainly an important part of their business.
Gotcha.
And so that placed some pressure on volumes. In 2023, commodity prices were also lower.
Yeah.
So that impacted their volumes of things like crude oil and forest products.
Exactly. When commodity prices are lower, there's less drilling, there's less getting stuff out of the ground, waiting for better pricing. So, yeah.
And then lastly, there was a bit of just natural disasters in 2020.
It was a very loud, crazy weather year in Canada. We had fires and a lot of ice storms. It was just not a good year.
So that
freight.
So that impacted volumes a little bit.
Yeah.
No, I think the management itself doesn't know what the Canadian economy is going to do in 2024.
Nobody does. I mean, most expect the U.S. economy to have a pretty good year in 2024. A lot of people are expecting a recession in 2024 in Canada, or maybe both in North America. No one knows, though.
But as of right now, the CN Rail is currently expecting about mid-single-digit volume growth. So pretty good.
And that's kind of been how it's done normally, right? COVID kind of messed things up, went boom, boom, boom. But in normal periods, CN and CP, the amount of freight volume that they move slightly goes up every year.
Yep.
And then there's pricing, and
Yep.
that's how it works.
And on the pricing point, like historically, they historically raised prices by a bit more than inflation, which has come down substantially. And there's also a bunch of idiosyncratic opportunities that are not related to the economy. So, for example, they're building a new line for a new potash mine in Saskatchewan for BHP.
Yeah.
They've just started to move propane for AltaGas
Okay.
in Prince Rupert. Right, these kinds of little things that I think add up over time.
That's right. And if you're bullish on Canada, the population growth, we'll need to be building more cities, more hospitals, more apartment buildings. We'll need more cars, we'll need more Tim Hortons. There's going to be more stuff that's required.
Yes.
And that stuff can be moved by trucks, but a lot of it has to be moved by rail.
Yes.
Yeah.
And so I think the new CEO has done a good job of improving the operations so far, namely improving train speed and improving dwell. And I think I'm very happy to hold the stock here.
Yeah, we talked about on our podcast before how it was shocking to us to learn that the railroads have outperformed the banks over going back 25, 30 years. But if you look at the metrics, it shouldn't be a surprise. The stock market tends to reward companies that have sustainable growing earnings, not wonky earnings where it's boom bust. It tends to reward companies that generate high returns on equity. A return on equity is another way of saying how companies are profitable with the cash that they generate, as well as high returns on invested capital. That's when they put that cash to work. And the railroads in Canada have been fantastic operators. There's been some tough years, some lean years, but definitely, they've outperformed the banks. Quite recently, we talked about the railroads haven't had good performance, but that's really a function of a tougher economy and messed up COVID. But I see going forward, Ernest, the railroads are guiding for double-digit earnings growth, both CP and CN for the next few years. You should get share buybacks. You should get dividend growth as well. You got to be bullish on the rails.
And I think one last thing I would add on the rails is that a lot of the freight that they move is not too tied to the general economy. So, for example, like they move a lot of wheat.
Got to eat.
They move like crude oil to crude oil for to export markets.
Gotcha.
Right? Like these are not too sensitive to what's happening in the Canadian economy. And so even if there's a scenario where the Canadian economy is not doing very well, they'll probably still remain solidly profitable.
Sounds good. Anything else to add about CN or Netflix?
I think one thing about Netflix, we haven't done books for a while.
Yeah.
Read Hastings' book, No Rules, Rules.
No rules, rules.
On the culture that he tried to establish at Netflix.
Reed Hastings, the former CEO, he's now chairman, or is he backed away from the company entirely?
He's the chairman, advisor, mostly working on charity stuff.
Gotcha.
His book No Rules, Rules, I think is a must read for anybody who wants to learn about an innovative approach to management and people at the firm. Netflix has a very unique culture that seems unlike any other firm that I've studied before, and it's well worth your read.
And we've mentioned many times, if you want to learn more about the Canadian railroads, please read the book Railroader. It's about Hunter Harrison, written by Howard Green, former anchor at BNN. Just an amazing book to learn, the history of the railroads and why they've done so fabulous. And we're, like we said, we're pretty positive on them going forward. So that's all the time we have for you today. We'll see you back here real soon. Thank you very much.